Hi, my name's Tyler Moore, and I'm going to be presenting to you guys today about Salesforce.com. So a little bit first about the company history. Salesforce was originally created in 1999 in Delaware. They later moved to San Francisco, California to be closer to Silicon Valley and the entire tech boom in the early 2000s. Their CEO is Mark Benioff, and they initially went IPO with their public offering in 2004. They have more than 35,000 employees that work across the Americas, Europe, and Asia, and they have close to 4 million subscribers to their product. And so the product that they do provide is called the CRM cloud software. So going into the industry analysis, the industry that they are in is high tech. And so what they offer is called a CRM software, which stands for a customer relationship management software. So what that provides is an external service or a software for a company, whereas an ERP company is going to offer more of an internal operations and such for that company. And so a couple examples would be for the offerings that they do offer. So their flagship product is the Sales Cloud. And so the Sales Cloud provides close to 90% of their total revenue of what they generate each year. And so what the Sales Cloud provides is a automated software that allows for sales regardless of the industry or the geographic location of what it is, and aids those sales teams in helping to close deals or manage their clientele. And it's all based around those external services between the customer and the client. But what Salesforce provides is for the Sales Cloud software itself is a business to business software. And so what the Service Cloud is the same idea of having that business to customer relationship, but instead of managing the sales and maybe their subscription for something, it's going to manage their customer service behind it. Say it's a software company and someone's having an issue with their platform, they can use the Service Cloud to allow for connection between both parties to resolve whatever the issue may be. And so the third product they offer is the Marketing and Commerce Cloud, which is essentially just a online marketing software. It is not as developed and sophisticated as the Sales Cloud is, as it is a dominant product for the CRM softwares. And so three other offerings that Salesforce does offer is called the Lightning Platform, the Integration, and Collaboration. And so these three softwares are actually not necessarily developed by Salesforce. And so they are growing within their industry through various vertical integrations, in that those different platforms that they're obtaining are through acquisitions. So an example is the integration. It was acquired from a software company called MuleSoft. And so what it allows companies to do is, regardless if you have a cloud software or whatever service provider you may have, this software will integrate all your other softwares together. And say, for example, it is your CRM software. It will integrate that with no coding or anything, and to have easier implementation of converting over into creating a all-in-one place platform software. It just makes the process a lot easier for clients to adapt if they do want to switch over to a Salesforce or a CRM software like that. And so the business strategy, I felt, was really based around the core values. And so these core values actually really tie back together to the financial data as well. So the first one is trust. Salesforce is as popular as it is today because of their brand loyalty they have from their consumers. They initially released their Sales Cloud in 2000. And so they've been retaining these clients for years now, and there's such high switching costs to go somewhere else, and they're happy with what Salesforce offers. And so it's a core value of theirs that they have this trust and they remain this trust with their clientele. And the second item is customer success. And so what this establishes is a precedent in that if their customers are not successful with their product, what would be their reasoning for purchasing a software such as Sales Cloud? Because Salesforce's clients want to have their clients be successful and happy with what they're offering. And there's no reason for them to offer Salesforce's software if they don't feel that way about Salesforce. So it's very important that Salesforce, again, has that strong clientele, and really even going back to having that trust between their clients and the software that they're providing. And so the third item is innovation. And so this just kind of comes with the nature of the high-tech industry, in that every company that is coming up is trying to innovate the new big best thing. And so what Salesforce did in 2000 is they did develop the new big best thing. It was their CRM software. And so there's other companies out there now who are trying to develop the next best CRM software. And so one of their core values is they put in a lot of money into research and development to stay ahead of that curve and to avoid any sort of substitute from a different competitor that may have a software that is superior, but yet the company may be young enough to where it is a much more affordable software. And the last item is equality. And so equality falls under the Salesforce culture within their company and what they refer to as the Ohana culture of everyone is family, and they invest a lot of their money and capital into having that employee happiness and success. And this actually ties back into the financial analysis as well. And so when going into the first analysis, I wanted to start with the comparables analysis. And so the three main companies that I use to compare against are Oracle, Zendesk. And so Zendesk is also a software company. And like I mentioned earlier, the second product that Salesforce provides is Service Cloud. And so what Zendesk does, they specialize in that service software to allow for businesses to reach out to those customers and remotely work with each other. And the last one being Microsoft. And both Oracle and Microsoft actually have subsidiaries that are more so competitors with Salesforce, but Salesforce's numbers are actually still competitive and relative to comparability between both those companies. And so when performing the analysis, I got a firm value for Salesforce of $64 billion and 90,000, which comes out to an intrinsic value of $83.13. And so with this valuation, it is less than that of the market value, which is $159 as of last Friday. And so when valuing it, it would be valued as the market value is overpriced and that it would be appropriate to sell at the time. But like we've mentioned before with this analysis, there's just not enough information to really make a financial decision based around it. And so this is, I felt, was a good starting point to understand what the industry was like and to see what it was going forward into the other analysis. And so going forward into the discounted cash flow analysis, I'll start first with the given information that I chose. And so for the top line, start with the growth rate. I decided to have 20%, which is a high rate going into the analysis. And so the way I derived that was I took the revenues from the past couple of years, and they have such a high growth rate between their revenue that it was actually coming out to be higher towards closer to 25%, but I wanted to take more of a conservative approach. And so I used 20%, which is still a very high growth rate from year to year. And so going forward, when choosing the rate of return and long-term growth rate, through previous examples, 5% was the ceiling threshold that you could use as the long-term or terminal growth rate. And to determine the rate of return, I just doubled the 5% from the long-term growth rate to determine that. So when conducting the analysis, as you can see, the firm value and the intrinsic value are both negative numbers. And so the issue with this is, like I mentioned earlier, Salesforce is an innovative company and a high-tech company, and so there's a lot of research and development that goes into it. And because of this, there is a lot of financing activity. And so what it's resulted in is more financing activity than there are business operations and cash flow from operations. And so it's turned the value into a negative number. And it doesn't necessarily mean that this model is void or shouldn't be used at all. It really means that it's holding true to what management has set out as their goals, going back to those core values of they do want to still be innovative. And I think this is a quantitative support or evidence that does support this, that they are putting that money into the company growing. And I think that should be factored in when deciding to invest or not. Because if you have a company that's putting forward that much financing activity, there's reason to believe that you can choose growth rates just as 20% for that amount of growth. So no, we cannot use this to determine what the firm value is, but I think it can be used as a factor of determining what the value or even a decision-making factor going forward of whether to buy or sell their stock. And so going into the next standard financial statement analysis, the residual earnings analysis, I used the same given information that I used for the discounted cash flow analysis. And so when performing this one, I did get a positive number. The intrinsic value I got for this was $8.54, which is very low in relativity to the value that was portrayed on Yahoo Finance of $159. And so the issue I saw with this, again, goes back into the firm's core values. And so what they stated was going back to the equality trait and the Ohana culture of they put their employees as their top priority, and they've been known to actually take away their earnings from quarter to quarter or even at the end of the year and reinvest it into the company in hopes that they can either expedite or get a good return in the effort and the ideas from those employees. And so I think this had an effect on the earnings per share for 2019 going forward into the future, because it's so low that it has given a very low intrinsic value as well. And so I think this is not a true portrayal of what the intrinsic value truly is. And that's just the nature of the company. That's what they choose to do, and that's one of their core values. But I think it definitely has an effect when analyzing and deciding whether or not to invest into the company with using this model. And so going forward into the ratios, I looked at these ratios more so on a macro scale. Rather than breaking down each one, I noticed a common trend between all of them. So when going through the notes, it's stated in there that if the analysis is rescinding down, then it means that the operating income, the generation from that is going to also be going down in line with those as well. And so what it may show is, like maybe the discounted cash flow model, the company through the model should be going bankrupt, when that's in fact not true at all. Salesforce is very healthy and their stock price is actually going up each year or even each quarter. And so I think this as well should be taken into effect of deciding whether or not to analyze it. And I think this is too short term of material to make it immaterial. I think there needs to be more research gone into it, that maybe it was a bad year and there was lots of financing activity that was going on, which is also shown on the other models, that has led into this decrease in this regression in the ratios and into the operating income. But I think it should be noted if going to be making an investment this year, but I think it should not be factored into a long-term or macro scale of an investment. So when going into the last statement, the reformulated pro forma statement analysis, I felt this was the most relevant for Salesforce because they had so much financing activity going on and so much going into research and development that there needed to be a true analysis of just the operating income. And so when performing this, it actually came out with a value that I thought would be valued at. So when going through and filling out all the information and populating it, it came out with a value per share of $230.92. Sorry, $230.92, which is significantly higher than the Yahoo market price of $159. And so although this is only one of the four, or even you want to call it 5 valuations that were done on Salesforce, I think this is the most accurately represented. And I think it leads into the next slide I think Salesforce should be a buy, but because of how much financing there is going on, it would be a risky buy. I think they've shown lots of growth, and I think because there's so much research and development and really even following the trends of other high-tech companies, that there's no reason to believe that they will continue to grow and these financing activities will pay off into the future. And even though the ratios and valuations were low and showed that it should be, stock is overpriced and the value should be sold immediately, I think in the long run, if you were to invest into Salesforce and hold on to it, it would pay off over time. And it may not be the next year or the year after, but I think in the long run, Salesforce will pan out because of the emphasis that I made on those financing activities and through the support from the reformulated pro forma statements. So thank you for listening, and please reach out if you have any further questions. Thank you.